Good morning, everyone. Thanks for taking time out of your day on a hectic day, another busy one in financial markets. Appreciate you joining us. With me on the call is Rebecca Robinson. Rebecca, are you there?
I'm here. Can you hear me?
Yes.
All right, great. Well, good morning and thank you everybody for joining us today for our regular market update, especially in a day that likely feels far from normal. As we start these calls, we always like to stress that our wealth management team genuinely believes in the power of long-term investing. But we also know in times like these, it's natural to have concerns. And we think most of us are wired to kind of flee when facing tough times. We know it's a difficult environment, and while it's a little bit scary, we also really believe that it's temporary. So our goal today is to share with you some insights on what informs that belief. As we'll cover with you today, I think it is important to keep in mind that we have seen times like these before on many occasions. And I think, well, one of my favorite statements, this too shall pass, it might seem a little bit hollow or naive right now. We do need to remember that it's fairly common for stocks to enter bear market territory without that being an indicator of a recession. And I think though it's difficult sometimes to focus on the long term, we do believe this is one of these situations where eventually we will look back as a unique opportunity. If we think back to 2008, I think it was likely difficult at that time to envision ourselves in a positive position in the future, and it was very hard to see sort of the green shoots when few of us could really envision the emergence of a positive market coming out of such a deep financial crisis. But for those who sold in a market storm, unfortunately, we really never remember when the clouds lift, and that's why as we look at our investment philosophy, we really do believe that having a plan, knowing what that plan is and sticking to it, and then relying on those that you seek advice from, your advisors and your bankers, is really, really critical. So today I'm joined by Anthony Valeri. Anthony is a director of investment management for Zions Vancore Wealth Management. He is a chartered financial analyst, and he leads the investment committee for our organization. Anthony has very, very extensive industry experience, and he has shared this expertise on multiple national news channels, including Bloomberg, Fox News, and CNN, just to name a few. Anthony's going to give you some insight into our current perspectives on the market, as well as going to address some of what we're doing with regard to recent market turmoil. So with that, I will hand the call over to Anthony Valeri.
All right, thanks very much, Rebecca, and thanks again, everyone, for joining. What I'd like to do is take the next 25 minutes or so to give you our thoughts on the market and where we stand with the coronavirus, also this recent oil news, and how we view financial markets and what to expect going forward. This call will be recorded and available online, so just so you know that, please contact your wealth management professional if you need access to it at a later date. But why don't we go ahead and get started with our summary points here. The number of coronavirus cases in China is decreasing, but globally increasing, specifically in Europe, most notably in Italy, where the entire country is on a lockdown, and it will be increasing in the U.S. as well, is increasing in the U.S. And a lot of this has led to fears over just what is the economic impact of these lockdowns of regional areas across the globe. The oil price war, that news came out over the weekend, comes at a very bad time. While that's positive for the U.S. consumer at the margin, it's a negative from financial markets due to possible stresses in the high-yield bond market. I will talk about that more in a moment. I think what we're seeing is historic. I think we'll look back on this as one of these moments, one of the more severe pullbacks, and a combination of news at work. To that note, stocks are down nearly 20%, actually, as of this morning. Stocks are down, and that number is 18%. That's near the bear market territory or threshold that 20% signifies. Lots of bad news is priced into the markets, in my opinion, including an increased risk of recession. But when you do have these types of conditions, they usually don't unwind themselves very quickly. So it does take time, it takes patience, and I'll talk more about that. We are seeing signs of selling extremes. Those tend to be contrarian indicators. So when people rush to the door to get out, there's panic. That can usually set the stage for an ultimate stabilization and subsequent rally. But I don't think those indicators are broad enough yet to suggest that there is truly that selling exhaustion and the market's ready to move forward. So I think the bulk of the damage is done, but there's more work to do. Separately, the White House is considering various stimulus measures to aid specific workers and industries that are affected. We were supposed to get an announcement yesterday that did not happen, and I think that's part of the reason why markets are lower today. And the Federal Reserve is widely expected to cut rates again and may even go beyond that with restarting lending programs and at the extreme even restart certain bond purchases. I'll talk more about that as well. Current episode is a lot like what was witnessed in 2011, the 2015-16 sell-off, and of course late 2018. We think this will pass, and we strongly encourage investors to remain committed to a disciplined investment strategy. Now let's get into the details, and I want to talk a little bit about what areas of the economy are most specifically impacted by all of this. And specifically, travel, energy, and hospitality are really the areas that are most directly impacted by the coronavirus. This is hotel occupancy. You'll see the impact across Asia and also in Italy. This is likely to get worse in terms of in countries across the globe, U.S. included. You're starting to see cancellations of major events. In Europe, sporting events are now going to be held without fans. So there is an impact to the industry there in travel and hospitality. That's where you're most likely to get that impact as well. You're seeing it in the airline industry as well. So global air traffic at risk of seeing its longest decline on record. So a sharp downturn in terms of bookings, and most of this coming from Asian airlines. You're not seeing a huge change in U.S. airlines as of yet, but it could certainly start to impact U.S. airlines as well. So these are the first two signs of data where the impact of the coronavirus is showing. And again, this is likely to show up more and more in economic data globally as time moves on. But again, we'll probably see more of that over the rest of the first quarter, but primarily in the second quarter. In terms of the coronavirus itself, efforts to contain the virus in Asia are working. And so the number of new cases, both in China and in South Korea, are decelerating. So that's good news from that perspective. You're starting to see activity in China pick up again. But the bad news is that we're going to see an acceleration, a continued acceleration in both Europe and the U.S. This week, oddly enough, marks the week in which U.S. testing is really supposed to ramp up. And I think as testing ramps up, you're going to see many more cases announced and publicized here in the U.S. That's going to be a negative headline for investors to fight through. You'll likely see increasing headlines out of Europe as well. So the news is going to get worse before it gets better, particularly due to the increases both in Europe and in the U.S. And that's going to obviously increase the potential for business closures, lockdowns, and those have knock-on effects to consumer spending, obviously the greater economy. So we'll be on watch for that. Economic forecasts are coming down for the full year, and even globally, the OECD put out their forecast, and I think this will come down even more. They've reduced global growth as a result of the coronavirus. I think this will come down even more. This will be the slowest, likely be the slowest pace of economic growth globally since the financial crisis in 2008 and the recovery in 2009. So there will be an impact. Europe, just a note here, the near-term recession risks have certainly increased, and that's particularly so for Europe. Italy was already just barely in recession territory at the end of last year. They are likely to fall into recession. There's a good risk for Germany, which had also narrowly avoided recession, to fall into recession here in 2020. So there's a very distinct chance Europe falls into recession as a result of this and potential closures. For the U.S., recession risk has certainly increased. I think the biggest impact to the economy will come in the second quarter, but most of the data we see points to a recovery in the second half and into 2020. So the impact from coronavirus likely to be sharp, likely to potentially be significant, but much of that concentrated in the March through June period, absent of real pandemic or global spreading, which I still think is a low case probability. So definitely be on guard. I think the news for the economy is a slowdown. It could get worse before it gets better. And ironically, a lot of this bad news on the economy and the potential for increased recession risk is starting to impact the potential election outcome. This is data from Predictit, which is sort of the kind of money or odds for a potential winner for a variety of political seats. I just chose the one for the White House, who will win by political party, and the odds for a Democrat to win the White House have improved over the past 10 days or so. I think a lot of this just due to the economic outlook. No incumbent president has really survived a recession and been reelected. So as recession risks increase, that threatens a potential change at the White House. So that's just one more factor, one more uncertainty that I think is contributing to the sell-off. And for those of you that did attend our 2020 outlook, you'll know that I mentioned that an election year typically sees more volatility, especially over the first 6 months of a presidential election year, and this is holding true to form. But again, this is one more factor that tends to keep that trend intact. So something to watch, another factor of uncertainty as we move forward, and I think we'll just take time to work through the markets. Economic data, oddly enough, before the impact of the coronavirus was improving, and improving at a pretty good clip. And so far, really not seeing any impact to the U.S. data. We'll keep an eye on some of the economic reports. Starting next week, I think March 16th will be the first regional survey that will really cover the period in which the coronavirus impacted the U.S. But this is the Citigroup U.S. Economic Surprise Index, and when economic reports beat consensus forecasts, this line increases. Conversely, when data is weaker than the consensus, you see the line decrease. And you can see the sharp increase since the beginning of 2020. The data reports have basically beaten expectations. Probably the one that most notably sticks out is last Friday's employment report, very strong report, over 270,000 payrolls added on the jobs front. You look at housing data had been stronger than expected. Both ISM indices, and these are surveys of both the manufacturing sector and the service sector, had shown improvement as well. So a budding improvement in the economic data, certainly relative to expectations, was going to create what looked to be better than expected growth for the first quarter. On a historical basis, nothing that would stand out too much, but when expectations were about 1.5–2%, it looked like GDP growth was going to exceed 2%. But given what's happened with regards to the coronavirus, that is old news to some degree. And again, some of the economic data points starting next week and through the remainder of the second quarter will be closely scrutinized to see the potential impact of that slowdown. Again, not seeing any signs of a recession. We'll continue to keep an eye out for that. Again, I think this will be more of a hit to the late first quarter, second quarter growth, and ultimately a rebound later in the year. Let me switch to oil prices now. That was big news over the weekend, and I want to highlight that energy is a much smaller part of the overall U.S. economy. And what this chart shows is energy exploration and mining as a percentage of the U.S. economy. In 2015, which was really a year where I think the shale industry and domestic oil had probably reached an excess, the energy exploration and mining was about just over 11% of the U.S. economy in terms of GDP. Now that's just over 5%, so a little more than half of what it was back in 2015. So really no excess in the energy sector that this drop in oil prices could have that material an impact. We have seen this before. Russia and Saudi Arabia and other members of OPEC fought over supply limits in 2015. They did flood the market with oil back then. Whether this was an attempt to sort of undermine the U.S. shale industry, it didn't work then, and it's unlikely to work now. Yes, there may be bankruptcies in the energy sector. I think that's the next watch out. But ultimately, those stronger players will survive, and we'll still have a shale industry here in the U.S. So there are some knock-on effects to that. If there are bankruptcies, if there are closures, that will be a drag on the U.S. economy. It's something to watch, but ultimately, I don't think this really changes a whole lot other than being a dampener to economic growth, and of course, one more worry for financial markets. There are knock-on effects to the decline in oil. It is a big part of consumer price index or inflation measures, so the lower oil will lead to lower inflation, which in turn will lead to lower bond yields and will also make it likely that those lower bond yields, lower interest rates persist. It will be one less catalyst to push rates higher in the future if inflation stays low. So there are some knock-on effects. Of course, the consumer benefits as well from lower energy prices. India, of all countries, also benefits, is a big consumer of outside energy, will benefit as well. So there are some benefits here. I don't think, but again, since the U.S. oil is now, because of the shale industry, a part of the U.S. economy, I think there will be some knock-on effects. By the way, on a separate note, oil prices, when they are down just over 50% from the peak, has generally been positive for the U.S. equity market. That's only happened 8 times previously, and 6 out of the prior 8 times, the market was up double digits over the subsequent 12 months. So potentially those lower costs could be a catalyst in the longer term for the U.S. economy and the U.S. consumer. One area that we are watching more closely in terms of energy, where we think the potential knock-on might be, is in the high-yield market. The energy sector is about 14% of the U.S. high-yield market, and it's important to realize that if there is a disturbance in credit markets, it can reverberate through to the rest of the economy. Higher borrowing costs can therefore ultimately slow down the economy in sort of a secondary way. And we are watching that closely. So far, the damage is primarily constrained to the energy sector. What you see here is a rise in the average yield spread of high yield bonds to treasuries, and that's gone up close to 6%. You can see it's below the 2016 peak, which almost hit 9%. And if you go back to 2011, that almost reached 9% as well. So compared to recent relative events, and 2011, by the way, was the European debt crisis. It's also when the U.S. Treasury rating was downgraded. 2016 was the energy crisis I spoke of. Both those periods saw significantly much more weakness in the high-yield market. It's possible we get close to that level, but credit markets in general are much more well behaved, and I think this is a signal that the bond market is really not overly worried about the coronavirus or the potential oil impact. Certainly something to watch. I would expect spreads to go a little bit wider. They're slightly above the long-term average of 5% currently, but again, relative calm here, and it's something we continue to watch. I think it'll be constrained to the energy sector, but this is one area, again, we'll watch. We'll see if there's a reverberation to the broader credit markets. Central banks around the world are providing stimulus, and you look at the countries in pink there have cut rates. If you look at Europe, you can see note rate cuts. However, the European Central Bank is meeting tomorrow. The Bank of England met today and cut rates. The European Central Bank, it's unsure whether they cut rates because their overnight rate is already negative. However, they may institute various lending programs that are targeted to small to medium businesses so that they can more easily adapt to the shutdowns in Europe that are a result of the coronavirus. So look for some lending facilities, which I think will provide some help. And this is just one way of how central banks are doing what they can to ease the impact of the coronavirus on local economies. So there is action being taken by central banks to help ease this burden, and I think this will be helpful, even though rates are low at the margin. This will help. And if you look at the U.S. Fed, there are big expectations of rate cuts in the U.S. Now, the Federal Reserve will be meeting next week, and they are widely expected to cut rates again. Another 50 basis points worth of rate cuts expected next week. That would take it to about 75 basis points on the overnight rate. And then you can see this line here, which shows where the implied Fed funds rate, and this is measured by futures, lies at various points in the future. And you can see a steady decline. Ultimately, the futures market is saying the Fed's going to cut back almost to zero by June of this year. So another 0.5% expected next week. Another rate cut expected at the end of April. I mean, there are 3 rate cuts basically priced in by the end of April. So pretty aggressive expectations from the Fed by the bond market. And again, if you look out, the further right you go, you look at 2021, those rates are expected to stay low for quite some time. These expectations will change, but it just shows you that the bond market really asking the Fed to cut rates. They probably will follow through. By the way, you haven't heard from anybody from the Fed this week, and you won't. It's normal. They are normally in a blackout period ahead of any meeting. So their next meeting, you won't hear from them until the meeting itself, conclusion of that next Wednesday. Also, if it's don't be surprised to hear of other measures. It's possible the Fed could start a lending facility like they did during 2008. They could, at the extreme, restart mortgage-backed bond purchases to help consumers, although the drop in treasury rates has been dramatic, and many folks, certainly colleagues I work with, have tried to refinance. You are getting better rates, but the drop in rates hasn't mirrored what's happened in the treasury market. So to aid that, you may see the Fed restart mortgage-backed bond purchases. I think that's more of an extreme, but that's one measure that they could take to sort of ease the economy through this slowdown. And because of those Fed rate hike expectations and also the downdraft to growth, you're seeing a historically large change in bond yields, almost a full percentage point drop across the maturity spectrum. And you can see the dramatic shift just from the middle of February to the close of business on Monday. Just a big drop across the board. At one point, the entire maturity spectrum was yielding less than 1%. So fairly significant. We had expected bonds to do about 2 to 3% for the full year. They're exceeding that. This downdraft in yields, unfortunately, does have longer-term implications for bonds. So we're expecting lower returns in the 1 to 1.5% range for the broad bond market, not just treasuries. But again, big move in the bond market. And I think a lot of this reflects the fact that from an investment perspective, the only true offset to risk are treasuries and high-quality bonds. And I think there's been a rush from investors and from hedge funds to really hedge that risk on the equity side with fixed income, high-quality fixed income. And I think that's exacerbated this move. But with the Fed poised to cut rates, we're looking at low interest rates here, and also oil coming down. We're looking at low interest rates for an extended period of time. So big and extraordinary moves in the bond market here. Again, the Fed is likely to provide some assistance, as are other central banks. What are governments going to do? I talked about fiscal policy assistance, and that is likely coming. The market's clamoring for that. It's not uncommon. Here's a table of prior fiscal policy assistance in recent years. A lot of what's been talked about for the current episode is to provide a payroll tax cut, and this doesn't provide a lot of money, but it can be significant. At the margin, it's going to help U.S. households. You can see prior episodes vary from about $600 to $1,000 per household, depending on the specific cut, whether it's a payroll tax cut or a tax rebate. I think investors are looking for something a little more targeted towards the travel and hospitality industry here, or workers that may not be able to work just due to lockdowns and closures. So I think that's what the markets want. We'll see what comes up of it. By the way, there was $8.3 billion approved last week. That was aid specific to the healthcare industry to help contain the coronavirus, develop vaccines. That'll be spent slowly over the coming 12 months. So that is separate. Again, investors looking for some sort of stimulus. I think we'll get it. It's just dependent on whether it's extensive enough to sort of please investors and help aid the rebound in the market. By the way, after September 11, the airline industry, and this is an example of what we could see, the airline industry received financial aid from the government. So that's the type of assistance I think investors would really like to see from the White House. But we'll keep an eye on that. But again, that's what the markets are looking for. And then let me turn to one of my favorite charts in terms of investing, and I'll spend more time now more on the direct impacts on the stock market and what we expect. Really important to understand that volatility is a normal part of investing. It's never fun. It's uncomfortable. It doesn't make you, certainly doesn't make me or anyone else feel good when you have these sharp, swift declines. But it's important to realize that volatility is an annual occurrence in financial markets. So this chart shows two things. One, the calendar year return of the U.S. stock market all the way back to 1980. Those are the dark blue bars. And then the intra-year decline is demarked by the red dots and numbers. So at what was the maximum peak to trough decline in the stock market during any calendar year? And it might surprise you to note that average decline is almost 14%. It's actually 13.7 to be exact. So although the average intra-year decline is almost 14%, most years finish positive. So 30 out of the last 40 have finished positive. That's a 75% success rate. So despite that intra-year volatility, you tend to have positive finishes. So it's just important to not lose sight of the fact that declines are a normal part of investing. It's you just have to take it as part of they're difficult, but it is a normal part of investing. Let me move to the stock market and valuations. So the market had entered this current period expensive. That is no longer the case. The most commonly watched valuation metric, the price to earnings ratio, is now at 18, actually just below that as of today, and roughly in line or slightly below this 15-year period average. And it's not far off the longer term, or roughly slightly below the longer term average as well, if I was to use 25 or 30 years worth of data. And you can see at the current PE ratio, it's rarely been lower since 2016. So the argument that stocks are expensive is certainly no longer valid, and I do think we are very close to fair value here. It's the uncertainty over corporate profits and the potential impact that is still affecting investors. But from a valuation standpoint, back to what I think is fair value, pretty close to it. And keep in mind that the PE ratio when interest rates are low, and that's definitely the case today, the PE ratio is generally above average because the lower interest rates make bonds less attractive relative to stocks. So valuations have corrected. I think they're close to fair value. The missing part is what happens to profits, and I'm a big believer that over the long term it's profit growth that drives stocks, not the economy. And profit growth for this year was expected to be we expected to be about 3 to 5%. Now, with this potential impact to the economy, it's possible that earnings growth could be 0 or even decline. And so what I've done is looked at S&P 500 price levels relative to change in profits. So if you look at the third column from the left, 0% growth, in other words, if profits don't grow at all, if they, instead of growing 5%, they grow 0, you can see various numbers there corresponding to a PE ratio. So if you look to the left and you go to the 18 for PE ratio, and then to the column under 0, it shows 29.34 as a potential fair value level for the S&P 500 if that is the ultimate profit growth. And the S&P as of Monday's close was 27, let's call it 27.50, was below that. So that would tell you it's slightly cheap relative to fair value. Conversely, if profits decline about 5%, then that number, that fair value, drops to about 27.87, which is roughly where we are now using the same 18 PE ratio. That red box sort of outlines what I think is sort of the general target range of fair value for the S&P 500, and it lines up with sort of our PE ratio analysis. The two boxes there highlighted in gray are really what I call the more pessimistic scenario. So if the economic contraction is sharper and profits decline 10%, now no one is calling, I think there's only one Wall Street bank calling for a 10% decline in profits this year, but that's a pretty pessimistic scenario. And in that case, I could see the S&P dropping down more to 2494, or let's call it 2500, which is another 9% lower than where we are currently. That would be a bear market, and that would be a pretty severe correction. I hope that doesn't happen, but I think that's more of a pessimistic case for investors to keep in mind. And ultimately, if you had the analysis, how bad could this get? That's possibly where it could go. The 16 PE ratio, which is the first line, it's very, very rare to see that kind of metric on the stock market, so I don't see the index falling to that level under various profit scenarios. But again, this is where we're watching to see what profits do. I still think flat profit growth at 0% is a more likely outcome this year. So I think, again, that stocks are close to that fair value, just need to see some momentum clear out of the market. And we will update this periodically throughout the year to see how that profit growth is developing. So far, companies haven't really announced any profit or earnings reductions. We'll start seeing those here over the course of the coming weeks. First quarter earnings season, which probably won't be that impacted, starts April 15th. That'll be our first market to see how profits are developing. On a shorter term basis, however, markets price in a lot of negative news, and it's important to realize just how much is extreme in the market. And one way to measure that is looking at how many investors are buying insurance, and you can measure that with the put to call ratio. So the more investors buy puts, which is downside protection, the more signs of panic and extreme. And typically when that put to call ratio spikes, like it did in late 2018, also early 2018, if you go back to 2016, you also see a spike. You see a spike around in 2007, late 2016 as well, corresponding to the election. all of those sort of began to mark a potential bottom in the market. And as terms of an extreme, check the box, we're definitely seeing that with investors buying insurance here following this decline. So this is a sign of an extreme. It's usually a contrarian indicator, and when the markets get this panicky, it's usually a good time to buy based on this metric alone. There are other metrics. CNN publishes a fear and greed index. It is one of its worst fear readings on record. So there are definitely signs of extreme pessimism in the market, and those are some of the necessary ingredients you need to ultimately get a bottom. So we're starting to see those extremes that suggest that we're in the process of forming a bottom in the stock market. But as you move forward, there's still some measures that are not what we call fully flushed yet. So the percentage of S&P stocks that are down 20% from their 52-week high is about 47% currently. Actually, that number is a little bit higher following recent data, and we'll see where it is after today. But prior peaks have come at about the 55 to 72% level. So I'd like to see a little bit more of that pessimism reflected in a broader range of stock prices to say that, look, this has gotten pessimistic enough, and again sets up a contrarian measure to where the stock market bounces. So while a greater number is showing that pessimism, there are some that don't fully respect that extreme pessimism. I think we'll get there, but it's just a matter of a little bit more time. Other metrics that we follow, the Association of American Investors, they go out and sample investors and they ask them, are you bullish or bearish? The percentage bearish has increased steadily, but is still below the level that has typically been associated with a bottom in the market. Pretty close, but not quite there yet. The number's approaching 50%, typically 60 to 70 marks of low in the market. And then the other factor we watch is buying power. When the market rebounds, when you look at the internals, is it broad-based? Yesterday, I can say that it was the first up day, despite some 2% up days last week, where the breadth was very strong, and we need to see several of those. Once that happens, that's more of a clear sign that the market has likely bottomed and is fully priced in for whatever negative news has come in. So a couple of metrics, several metrics that are showing, yes, this bottom has started, it's starting to form, but we have more work to do, in my opinion, on some of these other short-term sort of sentiment measures in the market. Now, it's not uncommon to have that. I'm going to walk through a few slides that historically we've used to sort of guide through that. In 2015 and 16, you can see there was a sharp sell-off. August of 2015, this started with China devaluing its currency. There was a retest of that low, but ultimately it took several months. It wasn't until February of 2016 that the markets ultimately bottomed. And again, this speaks to the fact that when you do have a violent sell-off, it takes some time to work through the markets to see some of those extremes worked off. Doesn't always play out this way, but this is one example. 2011 was another example. Weakness started in late July of 2011 in response to the European debt crisis. Then the downgrade, and it wasn't until a more robust fiscal policy response was enacted in Europe in October of that year that markets ultimately bounced higher. So that took a couple months in 2011. And if you look at the 2008 and 2009 period, similar example. I don't expect a 2008 example, but the sell-off began in September of 2008, and ultimately it was March 2009 when the rebound started. So again, I don't expect it to be as severe by any stretch as 2008 or 9, but it just goes to show you that these sort of sharp, violent pullbacks often take a while to work through. 2018 was, I think, an exception to that rule. A lot of it over Fed fear and some hedge fund selling, which, by the way, when we do have automated markets, automated selling, ETFs, unfortunately these sell-offs can go a little further than fundamentals might dictate, just simply to the dynamics of the market. But I will say in today's market, unlike 2008 or even prior episodes, there is no excessive leverage. The banks are in far better shape than they were in 2007 and 8. There is no bubble in housing. If anything, the housing industry is still very strong, and there's no investment overbuild like tech and telecom as was the case in 1990. So really no excess in the economy that would trigger a severe downturn. And again, I think the impact will be more short-term in nature. And another way to measure those sort of stresses in the marketplace, in 2008 you could see what the swap rate increase. Now this is a little inside baseball for those of us in the market, but basically This is the measure of risk between financial counterparties. So if you are a borrower in the financial marketplace and you're worried about the financial strength of somebody you are borrowing funds from, you ask more in terms of a spread or rate. You can see the spike in 2008. There was a mini spike in 2010 following what we call the flash crash in May of that year. In late 2011, that other sell-off I had mentioned, also a spike. But if you look where we are now on the far right side of this chart, less than 20 basis points or 0.2%. So really no signs of stress in the funding markets that would indicate some sort of systemic failure in financial markets. So not seeing it there. Again, wouldn't be surprised to see an energy bankruptcy as a result of the drop in oil prices, but in terms of a broad economic stressor or bubble, just not seeing that currently. Turning again to stocks, and this is why I think the bottom is forming. It's in process. There is an unprecedented yield differential between stocks and bonds. So if you're an investor and you're looking out longer term, which we always stress with our clients, that now is the valuation, despite the pain we've seen in stock, relative to bonds, is very attractive. The dividend yield on the S&P 500 now exceeds the 10-year Treasury yield by over 1%. That is a bigger disparity than what was seen post the financial crisis. You've seen this metric approach 1% on a few other occasions, early 2012 and also early 2016. Not coincidentally, the last time that we had severe sell-offs. So the signal that stocks are more attractive than bonds is certainly there. There's other metrics so we measure it, but on a long-term basis, stock returns looking much more attractive relative to bonds, and one reason why you should stay invested. A few more charts on investing, and this reflects our approach to be diversified and really have a good plan when it comes to investing. We are big believers in diversification. International has been a laggard relative to U.S. stocks, but this chart shows how the performance of international versus U.S. stocks over the past 12 months. A declining line means the U.S. is outperforming international, and a rising line means that international is outperforming U.S. And since this pullback started, you can see developed international stocks outperformed U.S. stocks by about almost 5 percentage points. So usually it's a smaller part of the portfolio, but at the margin you can see how this diversification is helping investors. And it comes at a time that I think is obviously needed. More importantly, having some bonds, which did get negative headlines because of the low yields, but they still work as a diversifier. Perhaps less so in the future, and we'll continue to provide thoughts on that. But look at the outperformance of bonds relative to stocks. In mid-February, they had underperformed stocks by about 10 percentage points. There's been a massive 24 percentage point swing. Let me say that again, 24 percentage points of outperformance of bonds relative to stocks over just a few weeks. That is just amazing, and it just helps to show the diversification power of high-quality bonds to potential risk in stocks. This is a big reason why an investor with a 60% stock, 40% bond portfolio roughly is down about 4 to 5% year to date, which, yes, that is negative, but certainly far, far less than the decline from stocks alone. So it does show the power of diversification. That's how we approach the investment world. And let me just conclude with a few more thoughts here. Again, for how you invest, I mentioned the diversification. For investors with longer term 3-year plus horizons, we would stay with a disciplined and diversified investment strategy. Don't change now because of a blip. This does happen. Volatility is normal. Continue to stay the course. I think the only option to consider that we are looking at for client accounts is to rebalance, make sure those stock bond weights are truer to their longer term targets, and remember that timing the market is impossible. I don't think this is a question of do I buy or sell now. I always talk about investing as a process. Again, it's impossible to time the market, and for those trying to think about getting out now and getting back in, that suggests that you are going to time the market correctly twice, knowing to sell now and then knowing when to get back in. Avoid that habit. Understand that this is a part of the markets, and if you have an investment program going, I would continue to, along with that, and reinvest during this difficult time. Again, corrections are trying and difficult, especially ones that are quick and sharp like the current one, but it's time for patience, and we strongly believe that you will be rewarded over the long term, as was the case following 2008 and 9, 2011, and the 2015, 16, and of course 2018 period. So stay invested, continue to stick with that disciplined approach. And I'd also mention we are here to help with questions or concerns. Please reach out to a wealth management professional. We're happy to assist. And we will continue to provide ongoing communications during this market pullback and our thoughts on the coronavirus and oil prices. Thanks again very much for joining. I'm Anthony Valeri, and again, reach out. We'll have a recording available online later today. And again, reach out to your wealth management participants for additional details. Thanks very much.